Want to welcome you to this stream. This is London with Bitcoin Spike and VIP Trader. We're going to talk about technicals today. Former hedge fund owner, private, non-SEC, not financial advice. You guys know my story. Offered positions, formal positions with Morgan Stanley, etc. Top-notch, top-tier places. Chose to go my own route, open a hedge fund. I am in a trade group now. We love to beat the market. Bottom line, we love to beat the market. We welcome you to our stream. Settle in, get used to the flow. In terms of the technicals, we approach the technicals quite heavily. We've got the pro level setup in the back, 15 monitors wide, and it's there to provide insight. Let's go over some of the details now. And good morning. New York is open. Let's take a look at equities, first of all. In terms of the employment report came in, I would say hot. Yes, a little bit hot. We are down on equities, right? They've been relatively bulletproof recently. The jobless claims came in today. That comes in on Thursdays. You know that. Make a mental note. Jobless claims come in on Thursdays, right? It trades. In terms of Tesla, we have some action. Not financial advice. You guys know that. Former hedge fund owner, private non-SEC, not financial advice. We're going to go over Bollinger Bands today. I want to talk about what you see on your screen, why it is and how it is relevant as we were to talk about. And I always recommend that you watch this on a big screen TV. And good morning, guys. Hope you're doing well. Please watch this on a big screen TV if you can. All of our VIP traders are. And guys, I'm a VIP trader. That's the easy of that. Now, in terms of the details, let's take a look at the Bollinger Bands. I'm gonna argue today very quickly that if you are not paying attention to or you have no idea what Bollinger Bands are, you just choose to ignore them, that you are missing a big part of the boat, guys. It is a strategy which doesn't have much allure. It's not, guys. It's not your bull flag. It's not your prominently recognized major pattern. It involves a little bit of extra. Let's say just diligence on your behalf to understand just a touch about volatility, just a touch about mathematics. What is a standard deviation? Today, we're going to talk about the classic strategy in terms of over or under the specific pink line that you see on the bottom right. The pink line is going to be that 20 moving average. The 20 moving average is relevant for a ton of pro traders. All right, not the pro traders that qualified on a little get you or get you not exam with a prop firm. I'm talking about professional traders, right? Real suit, tie, up to the office, corner desk next to VP or is the VP level traders. They understand what standard deviation is. They understand what a 20 moving average is, right? Now, in addition to that, as we look at a standard deviation, we'll talk about Bollinger is wrapped around the 20 moving average. We all know that, right? It's got the upper and the lower band. We all know that, right? That's easy stuff. 95% of the price action is contained within those bands, within two standard deviations to the upside and to the downside of the 20 moving average. We understand that. What is a 20 moving average? Easiest thing in the world, right? Easiest thing in the world. And pay attention at Good Morning VIP. New York is open and it's down. You understand that? New York is open and it's down. Not severely. NASDAQ off about 0.68%. S&P off about 0.5%. And guys, we're mostly affiliated, I'm going to say affiliated with not. We are mostly inclined to look at the NASDAQ, without a doubt. Very important, getting an alert right now on BTC. What I'm going to say is I wanted to bring something specifically to the VIP because I know that you're trading Bollinger Bands. Okay, on the bottom right of your screen, I have the 5-minute, the 30-minute, I have the 4-hourly, and the 8-hourly. All right? Now, the classic approach is the following. Pay attention. This is what you're going to read and learn if you focus on the materials that the pro traders is not the stuff you're going to find on Google. Okay, not at all. The stuff you're going to find on Google or on a YouTube instructional. No. The stuff that you're going to find if you absorb the materials and focus on New York Institute of Finance, where Wall Street goes to school. Yeah. If you focus on what Wall Street, literal pro traders, right? Not your prop firm pro traders, pro traders, right? BlackRock, JP Morgan, right? Morgan Stanley, yeah. Goldman Sachs, big banks, where those guys, pro traders, go to school. Hey, what do those guys know that you might not know? Searching around or hunting on Google or hunting on YouTube. They are going to look at a strategy on guys. It's right out of the playbook. Where Wall Street goes to school. The trading tactic on Bollinger Bands is what? over the 20 moving average, what? You target the upside band. Under the 20 moving average, you do what? You target the downside band. Now, that's going to require, if you look at the 30, look at that 30 moving average. Do you see the inability? Okay, and we had a nice trade yesterday. By the way, we had a very nice trade on a pattern we've been talking about nearly exclusively recently. If you guys traded that along the level of support, congratulations. I know the VIP did, and boom, gangbusters, made some good money, guys. Good job. As we were to look at the details in terms of the Bollinger Bands, I want to add one component to the Bollinger Bands. It's going to help a bit in terms of your understanding of the second standard deviation. I want to add in one standard deviation. Okay, I want to add in the notion that you may have a variable target when you look at a lack of performance. First of all, on the 30-minute, take a look at the 30-minute here on the bottom right. Take a look at the 30-minute. Now, what is the notion here? 30-minute has been unable to achieve up and over. This is why multi-time frame analysis is critical. It is crucial. As you look at your multi-time frame analysis, and what happened today with the with equities, at least on the start, out of the starting gate, we got hit before the market opened with some hot jobs. You guys know. The labor market has been extremely resilient, to say the least. It does feel like the estimates on the market, if you guys will agree with me, it does feel like the estimates in the market are conjured a bit. It seems like we're continually being thrown an estimate in terms of a data release such as a jobless claims, and it just seems a bit conjured. It seems a bit fabricated. It seems a little bit like a continual setup as we were to look at these. Oh, we beat estimates again. Oh, we beat estimates again. Hey, come on. It just seems like there's a fading level of intent to be realistic with the estimates. Now, let's see what we got. A big drop on Tesla. Very interesting, big drop on Tesla. I have been assessing participants in the market. You guys know, not financial advice, but I've been assessing participants in the market, and particularly on Tesla, as they've been providing a hot and cold treatment. I told you to bring a blanket yesterday. You didn't tell us to bring a blanket yesterday. You know, it's the weatherman that got it right yesterday every time, without a doubt. I told you to bring an umbrella yesterday. It rained. See, I told you. No, every single time these people show up and tell you, beware, just be aware of this. Every single time an influencer or this or that will show up, and I'll give credit to Bloomberg, at least with Morgan Stanley recently. They gave him a bit of a reprieve. He said, out in terms of CEO. He said, out S&P at 3,900. Yes, okay, they're big King Kong cat. They're big cat, right? And in terms of that, what happened? They gave him a reprieve. When it went over 3,900 S&P, they just gave it a little bit of time. Give it a little bit of time for things to work out or not. They let it come back to that level. He was on yesterday. Morgan Stanley was on yesterday, and it was nice to see Bloomberg operate in such a fashion. It was relatively well done. We're going to talk about Tesla, and the reason that we focus on, that we absolutely focus on the fundamentals of technical analysis as presented to pro traders, is because I'm not going to tell you I told you so. And when I review, I'm going to tell you this, when I review channels, when I do a market analysis, and people say, you see, this was easy, you see, that was easy, I told you you should have done this and you should have done that. Guys, I literally, you talk about a red flag, sirens blaring, nuclear air raid siren. I look at the person like, come on, man. Come on. You can troll. These people are trolling, okay, if you want to look at like a Twitter or otherwise in terms of the ability just to troll, right? They're going to troll new traffic and expect the new traffic to come on into whatever system they're trying to sell you, and it's without the regard for any kind of a continual reinforcement of a group dynamic or any kind of a continual learning process or a profit, any kind of a real profit equation. It's pitiful to watch. I'm on record. It's pitiful to watch. I don't like trolls like that. Most people think trolls just follow people around on Twitter or something. They're trolling. They're trolling new, fresh, brainless people. Maybe not brainless people. Maybe nice people, nice investors who would show up and just believe, ooh, he just says he got it right. No. If we get it right, what is it? It's the New York Institute of Finance. If we get it right, it's what? It's the pro trader tactic. We're reinforcing the principles of the New York Institute of Finance I am a willing proxy for them. What do I mean when I say that? I want you to follow the standards that pro traders are following. If you do it on a diligent basis, cross time frame, guys, you're not gonna have much to complain about. I'm gonna tell you, if you do it cross time frame, you're not gonna have much to complain about. If you use the tools that we deploy in the market, and the probabilities that we deploy in the market from, again, the number one source of those probabilities. I mean, am I in the book sales business? No, I'm not. But I could be, to not deflect, but to just, as I say, act as a proxy. I literally just want to act as a proxy. That's the bottom line. You're seeing Tesla with a nice pour down. They didn't like the investor day, huh? Interesting, huh? Harsher reality on the investor day there than we had on Goldman Sachs. Very interesting. Some people just hate Elon. He could show up and do everything perfect, and some people are just not going to like him. Okay, so important pattern, not unlike, and please pay attention in terms of Tesla, if you're seeing this specific potential bull pennant on the hourly, very important. And guys, it is a security. I don't deal with securities. You all know that. I just don't deal with them. You want financial advice? Go to your broker. Tell me what your broker says. I'd love you to share some financial advice with me and our group. Let's see what we got on that. But looking into the equation on the Bollinger Bands, let's get back to that. Just wanted to bring up Tesla very quickly for you all, okay? Looking at Bollinger, what we're going to be talking about is an over-under. You understand, okay? The over-under. Let me go ahead and let's go on the 4 hourly real quickly. We could do this on Tesla as well if you guys would choose to do that. And shout out to Steve. Steve, my man, thanks for the comment last night. Appreciate that. Glad you're getting reinforced. Everything's getting reinforced in terms of the Bollinger Band tactics as well. Always looking at like the lowest denominator time frame, right? Can we look at like the 5-minute time frame? Right, are you over or under the 20 moving average on the 5-minute time frame? Very important. Very important to look at on your micro. People dig into the micro. Are they looking for a smaller pattern? Why would you look at a smaller time frame? Well, people want to know, are you in a smaller pattern? Well, typically we want a bigger pattern. Yes, you can go directional based on a probability from a lower time frame. You can, all right? But for patterns, we typically want larger patterns, okay? The larger the pattern, the larger the expected move in the market. So as we are looking at a lower time frame, okay, as we were to say, let's look at the 30-minute Bollinger, it's relevant just to the extent we haven't been able to get up over the 20 moving average, right? We have literally failed in the preceding number of, let's say, 14 hours to get up and over on Bitcoin, to get up and over the 20 moving average, right? As we were to gauge our involvement in a lower time frame, our lower time frames are highly relevant, okay? Not just for, let's say, just for targeting and trade, let's say trade dynamics. Again, we have the 20 moving average to me, and what I frequently tell the VIP is, if you want to make a drastic move to the upside, you're not going to do it without getting up and over this 20 moving average. You're just not. You want to slingshot and bam, move to the upside. You're not going to do it without getting up and over the 20 moving average. Bottom line. Now, within the context, and I'm trying to find a nice example here. And shout out to Venus. I have to say, Venus, you were interested in the failure yesterday of Tesla before the specific move on the investor day. Very nice intuition there. And looking at Tesla now, the market is assessing that power down through now. Boom. That specific 8 hourly. I think 8 hourly was in question that we were just talking about yesterday. Taking a look at that, do you see where we just shedded some light straight down onto our notion here, the bottom side band, boom, on the 8 hourly. Very nice. So we opened, boom, immediately on that downside Bollinger Band. Do you see that on the 8 hourly? And we were discussing that yesterday, Venus. Nice to see. Now, the strategy is what, guys? It is the crossover. As you look at Tesla, it's the crossover the 20 moving average on the 8 hourly and targeting the upside band. Now, something else is going on here. Obviously, it didn't just hit the upside band. It continued up, right? So the additional dynamic that I want to focus on a bit today are additional levels of, let's say, standard deviation levels would be the appropriate way to bring this to bear. You've seen me do this before. I'm going to add on some additional levels, some additional standard deviations. Okay, when I do this, the purpose is to define not only additional levels of volatility, which certainly we're doing. Let me go to the inputs on another standard deviation level. Let's just put in 1. I want to put in 1. Now, the purpose here is to identify with some degree of relevance and accuracy. I want to identify up and over 20 moving average and this internal layer here. A little bit of an internal layer that we're seeing once, that we're seeing twice. In terms of a performance to the upside over the 20 moving average and a barrier, bam, right into this level. You see the 1 standard deviation, right? So we're all accustomed to the second standard deviation on the upside and second standard deviation on the downside. That contains 95% of the price action. But as you engage in over or under the 20 moving average on whichever time frame you're on, as we look at Bitcoin, be apprised of the following. At times, you will notice kind of a ghost level, right? You'll see operation up and through the 20 moving average, and it's kind of like it's ghosting into some level. Now, if you're on our Fire and Ice, you're probably plugged into what it's hitting, okay? But if you're not dialed into Fire and Ice, you're probably not going to be aware of. Guys, that's our kernel regression. Very nice in terms of kernel regression. Very important to look at kernel regression levels, entries, exits in the market. Caught the bottom of Bitcoin. Very nicely done. Now, as you were to look at the first standard deviation, let's make this orange. Let's just completely change this up so you can see exactly what I'm pointing at. But I want you to be aware of the dynamic. Not on the 20 moving average. Let's do the upper and lower as orange. There we go. I want you to be aware of the fact that, maybe we do this white. We'll do orange. That's fine. I want you to be aware of the fact that traders are engaging at this first level, this first standard deviation. Okay? So as we were to look at the 5-minute time frame, most of the times you'll say, well, we get up and over. Now, this is I'm going to say it's differentiated. I like a clear break up and through. A clear break up and through and a candle set cleanly over the 20 moving average. Okay? That's what I personally like, a clearer signal on a time frame where the traders have been respecting up and over the 20 moving average to that second standard deviation level, the topside band. I like a clean candle set, boom. All right, I think, and guys, based upon back testing, you'll see that the traders overall like a clean candle set up and over the 20. So when we see a candle that sets through, it can compromise your decision making a bit. Okay, it just can. Looking at the patterns in play clearly, you'll get a better, I'd say, as we dig into the micro, which we frequently do. It can be tedious work if you're not accustomed to it, but if you love the market, it's not going to be a tedious thing at all. Looking at that 1 standard deviation, right? That 1 standard deviation. It's kind of that ghost level that's not going to be there otherwise, right? Looking at that 1 standard deviation. Again, like, what is it hitting? What is it doing? Now, it's hitting our Fire and Ice, but it's also right in line with that orange, that kind of that ghost level there. Here again, nearly perfect dead on with that 1 standard deviation. So when you're not seeing and you think that something is failing, dig in mentally a little bit and focus on the standard deviation levels and the possible targets that are between what you've aimed for, which may be that upside band, the second standard deviation, or the second to the upside, or that standard deviation to the downside. I think it's highly relevant, and I just didn't want you all to continue to engage in blindly target to the upside of the second standard deviation or target to the downside, and guys, the lower side band on the Bollinger, without having some wherewithal and some understanding that many times what's being hit is that first standard deviation. It doesn't come packaged as such on TradingView. You have to make that effort to add on another Bollinger Band with a standard deviation of 1, okay? That's going to be a degree of volatility, right? It's going to be a degree of volatility. And what do we have? What do we have in terms of degrees of volatility? Let's look at what we have in terms of a degree of volatility. We have, now we call it ZPAC. It is a measurement of volatility. Let's look at our specific indicator. I'm going to go through this so that we can refocus on just the way that we just hit into the standard deviation of 1 there is a tendency in the market, and please pay attention, there's a tendency in the market for hits on into and through on Bitcoin. Let's look at a standard deviation of either 1, standard deviation of 2. You'll see here on the chart standard deviation of 2. You'll see standard deviation of 3. You see this to the upside. This is our indicator. And the Z-Pack, as you're going to see, look at these volatility hits to the downside. Now, hold on. We just went through and we added, let's go ahead and add Bollinger Band. Let's put Bollinger Bands, let's go ahead and throw the Bollinger Band on there because the second standard deviation to the downside is highly relevant, isn't it? That second standard deviation to the downside, that's lower side band, but that's only covering through a standard deviation of 2, right? We just talked about maybe a tendency to pick up at the 1 standard deviation, really thinly insulated target levels and levels of performance around a 20 moving average. Now, if you wanted to change it to your favorite moving average, the 5, maybe you're a crossover king and you decide you want to play, you've got your own standard, your own protocol in terms of which moving averages work, it's fine. What's important is the tendency of price to consistently perform to the downside and to the upside. Looking at your hits, look at the hits at the standard deviation level, let's say of 3. Let's just reinforce this a little bit today. Variable targets in terms of an approach to volatility. That's not too complicated, is it? Standard deviation 2 is what? Classic Bollinger. To the upside, to the downside. Why is it relevant? 95% of the price action is included in there. What about the other 5%? What about the other 5%? It's not going to be in line with the 2. Well, let's look here. Here's the 3, and here's the 4. If we look at the 3 right here, guys, to the downside, there's the 3 and there's the 4. Okay, so as we were to look at the specifics, the notion would be the following. And good morning, Venus. Nice to see you. As we're looking at standard deviation targets, now you don't have to go all out there with your guys. You don't have to calculate anything. But standard deviation, a deviation apart from what? It's a deviation apart from a moving average, right? What's the average of Bitcoin over the last 20 days? What is the average of Bitcoin over the last 20 days? Go to your daily chart, right? All we need to do is go to our daily chart. We add in a Bollinger Band, and the easy thing about this, it's going to give you literally the moving average is over the last 20 days will be the center line. Will literally be the center line. So you could ask someone, well, what's the average over the last 20 days for Bitcoin? It's literally the yellow line that you see on your screen. I know that you know that, but we need to reinforce the mechanisms and technical guys know-how and instructional that we have here, the tools that we have. Now, what does standard deviation mean? It's a calculative. It's a volatility calculative. We want to know, right, that 95% of the price action is included. And I just tell you, if you look right at, we're right on the 20 moving average. That's on the daily. The last 20 days, what's the average of Bitcoin? That is the line. That's the 20 moving average that you see on your screen. Very simply put. So the fact that 95% of the price action is going to be encompassed within this lower side band and the upside band, right? Now, we're not getting into direction quite yet just by stating the lower side band and an upside band. And in addition thereto, as we have that discussion and formulate the notion that, well, if we're over that 20-day moving average, if we are over that 20-day moving average, there's an expectation in the market. There's a trading tactic, at least used by pro traders, the Goldman Sachs, the BlackRocks, the Morgan Stanleys, right? The traders have an expectation, if operating up and over that 20 moving average, of hitting the topside band. Generally, back test it on your time frame. Make sure it works on your time frame, that traders are paying attention to that time frame, and it's consistent, right? As we were to look at the relevance, we're right on the 20 moving average on the daily, without a doubt. Let me say good morning to Venus. Good morning, Venus. How are you? Good to see you. Let's see what we got going on. Let's put some trophies in there for you, Venus. Way to trade. So the relevance begins with what's the average of Bitcoin over the last 20 days? Throw a Bollinger Band on there. Just that's it, and you got the answer. The 20 moving average is the middle line. And I'm not selling tickets to John Bollinger Party. To the contrary. To the contrary, if it's a boring, nearly, quickly, overly antiquated style of a trading system, great. Throw your criticisms on Bollinger all over the place here. Throw them all over the floor, all over the headquarters. Throw them all over our headquarters, because I didn't see enough value in it either, which is why we have a demonstration here in terms of the technical componentry, the ability to see when are we performing beyond that specific second level of the standard deviation. That's great. 95% of the price action is there. Great. That's fine. What about the other 5%? What about the other 5%? This is where we get into, as you see on your screen. Look at this. They hit into the fourth standard deviation. They hit into near the fourth, right, standard deviation. Hit into here, the fourth standard deviation, right? We can look back. We see a lot of action on the third level of standard deviation. A ton on the third standard deviation on the daily. It's a lock, guys. It's a cyclical lock. I'm going to tell you, you want to see what's going to happen here in terms of it would be great if it would be awful. Let me say that. It would be great to be surprised. I say that generally in terms of technicals. It would be awful if we didn't see any more hits at the 3 or the 4th, let's say the 3rd or the 4th level in the standard deviation. Why? Because we need volatility. We need the price action. Capiche? We got it. We need the price action. So when you're looking at something, if you're going to measure something, and for people who aren't following or this is too complicated for them, man, if it's just too complicated to figure out what has more price action and to focus on the opportunities out of the 95% category of the market, and you don't want that extra 5%, you don't want that alpha, that's okay. That's okay. We're interested in the lock. Now, what's the lock? I'm going to tell you, it's a lock. It'd be awful to be surprised. But in terms of the cyclical componentry here, you're seeing hits into a third level of standard deviation. Now, rewind back to the beginning of the stream. We're also, on differentiated time frames, seeing hits into the first level of standard deviation, right? As we were to look at this on the 5-minute time frame, right? As we look at the second standard deviation up above and the second standard deviation below, we noticed that there's hits into like the first standard deviation, and that's it. And failure, boom, to the downside. We noticed, this is on the 5-minute, another instance here. Well, look at that, a hit into that first level of standard deviation. And boom, that's it. And look here on the 5-minute, another one, a hit into the first standard deviation. And boom, that's it. Okay, so your measurements of volatility, as you will comprise them, internalize them, and guys formulate them into your tactics, you're going to need to recognize variable levels in the technical componentry of volatility. You're going to need to be able to appreciate that there is a level of standard deviation between and outside the expressed norms of Bollinger at the 1. Yes, then his 2, given the second one, but then at the 3rd and the 4th and the 5th. Yes, beyond the contemplated norms as presented with John Bollinger. Now, it's not exotic thought. It's not out there, guys. It's not complicated. It is price action, right? Now, it's not a hard and fast rule either. As you were to look at, if we were to delve into the 8-hourly, and good morning, hope you're all doing well. We decided to stream yet again the New York Open, and we had some hot jobs information, hot jobs data. DXY looking nice, huh? Looking nice on the cusp of a breakout. Have you all seen the DXY recently? Let's take a look at the DXY very, very quickly. Talking about Tesla as well. Beautiful pattern. Beautiful pattern in terms of a bull pennant. Rough stuff with the open right down onto the lower Bollinger Band. Boom, trigger, huh? Nice open, guys. Nice open for Tesla. Yes, Tesla down 5%, making a decent recovery and a hit down into that specific line. Let's take a look real quickly at the daily. I want to see the daily on Tesla. Yeah, we're pushing right down into our kernel regression line on the daily, okay, the pro line. We'll call that a pro, but it's a failure of a nice pattern on Tesla, without a doubt. It's just a nice pattern. That's a nice bull pennant. Move to the upside, symmetrical consolidation. That's a sweet pattern, guys, for Tesla. So the jury was a little bit difficult, a little bit rough on Elon, in my opinion. But guys, not financial advice. It is a security, so go find your broker. Period. If they have anything valuable to say, you bring that stuff back to us. In terms of the details, let's look at the DXY on this specific screen here. Let's dig into. I keep putting it on the wrong screen there. Now, DXY, very, very interesting chart. DXY, dollar index, inverse correlation with equities, with Bitcoin presumed, although Bitcoin has the weekends to kind of dance around. You guys know that. Bitcoin gets to, and I just out of 2 or 3 days a week, Bitcoin is going to misbehave in terms of correlations. She has a tendency to do such. Right now, in terms of the 8-hourly chart, you're going to find differentiated time frames or differentiations amidst a target. Now, we've talked about some standard deviations. We've reinforced some of the Bollinger Principles. I've talked about a variable approach, not just the 2 standard deviation, but the 1 standard deviation, the 3rd standard deviation, the 4th, the 5th. I'm bringing it up not so that you will clutter your screens. Don't clutter your screens with it. You don't need to. We have the Z-Pack, okay, to visualize that. But the more that you're prepared for a hit into the 3rd, 4th, or 5th standard deviation, the more that you are prepared for that, and the capital line is beautiful. Our capital line is really, really nicely composed, okay? As you were to look at that, and that's a capital, literal, like your capital. Like, what is your capital doing in the markets? Is it, we've got it lined out as red, okay, meaning kind of an alert, a warning. All it is RSI, MACD, stochastics are dropping. The bears are taking over. The bulls are failing. Okay, at least being prepared for interaction with the 20 moving average is our approach on the capital line. But you see the specific volatility, okay, that's playing out here to specified volatility levels, which are expressed on the right-hand side. Let's just do this in terms of Z1, 2, 3, 4. Z1, 2, 3, 4 to the upside and to the downside. So as we encapsulate that argument or that discussion, you have this the componentry beyond John Bollinger here on your Z-Pack. Heavily calculated, and nice to trade both the capital line. Pay attention to the capital line in terms of the red, white, and blue. Boom. Blue meaning bulls are taking over, right? To the upside. You have the option on your, and pay attention. If this is new to you, I would recommend you pay a little bit of attention to it. In terms of the not for purposes, and guys, you can do the same with stochastics. You can do the same with RSI. You can do the same with MACD. You can do the same, okay? If you want to get into the details in terms of the calculations, we could technically do that. Be a little bit boring for the majority of people. In terms of the pickup zones here, though, within the capital line is a kernel regression average. Kernel regression, if that doesn't make sense to you, let's look into do research on Renaissance Technologies, on their 90 PhDs, numero uno hedge fund, and see if they're using kernel regression. Just see if they are. And maybe take that route as you approach the markets and your level of interest in technical details. Go look at Renaissance Technologies and figure out how they are using and deploying kernel regression formulas in their trading. Okay, and this is what we have here is a kernel regression formula as applied to RSI, as applied to MACD, and as applied to stochastics. I'm just going to combine those together in line with a 20 moving average. Variable moving average, definitely possible. Flip of a switch, no problem. If it's a little too complicated, relax. Maybe it won't be too complicated after a little bit of time and just understanding. Watch a few streams. In terms of the details on the DXY, why do we like the DXY right now? Because we are testing. Right now, we're in the process, and really on the 8-hourly, we've It's getting close, guys. What's getting close is the notion that we have had an upside target on the DXY. I informed you all we have an upside target on the DXY, and depending upon your time frame, we have met said target. What is the upside target? How is it relevant? Let's look at the 8 hourly. On the 8 hourly, let's just snug this in as much as we can. Let's tighten this up. What we're looking for is and I'll build this over into the Bitcoin chart if need be. I will build this over into the Bitcoin chart and show you guys really beautiful. Let's go ahead and do it. It's so nice. It's such a nice Bitcoin chart that it reinforces this principle extremely well. And good morning. Hope you're all doing extremely well. So I love the commentary and the little voice inside your head saying, this isn't doing me any good. I tuned in to figure out which way Bitcoin was going. Oh, okay. Is that it? It's not doing you any good, huh? Do you want to participate at higher levels in the market? Yes. Do you want to participate at lower levels in the market? Yes. Conscript out your orders a year in advance? Yes. You want to conscript out your orders in advance, a year in advance of the market? Come on, man. Yes. That's the level of thought process around here that makes the cut. Bottom line. Oh, you want the quick, easy answer? Oh, you want the quick, easy answer? Oh, I see. Out, out, out. Now, look at Bitcoin. Take a look at a parallel. Let's draw a parallel here between Bitcoin. Who got the bottom? The 29,750 here, summer 2021. Ba-boom. Nicely done. Nicely done. That would be us. Nice. 29,750. What did we have above us? Do we have any expectation of getting to the upside? Well, we had a specific falling wedge, typically a bullish pattern. Bravo. We had a falling wedge. Expectation was what? Expectation of a falling wedge is expression to the upside. So we had a divergence of price to pattern. Price to generalize expectations of the pattern, we had a divergence because the price failed to conform to the expectation of the pattern in the market. So what does that mean? Well, that means that we're going to target the apex of the pattern. We're going to target the apex of the pattern. And why would that be? That was the conclusion of the demand agreement between the buyers on support, sellers on resistance. You guys remember this, the $65,000 on Bitcoin. You remember that. We're going to draw a parallel here with DXY and what it's currently doing. 65,000. What happened here? Boom. Right to a nice Fibonacci level. Who dumped? Elon dumped. Big time. You guys remember? Boom. Who dumped? China dumped. Boom. Everyone worried about, isn't it great? Everyone worried about Luna, Terra Classic, and FTX, and look at the disaster-ridden complex of Elon at 65,000. What was he doing? He was testing the liquidity of the market. There's one way to take your profits. Huh? I'm just going to test the liquidity of the market. Boom, Elon. Boom, China, right? So level of support, level of resistance, daily Bitcoin, apex, divergence between price line and performance expectation of the pattern. We have a price to pattern divergence. Price should have gone up. The pattern failed. We will also target rising wedges. When they fail to conform in line with expectations, a rising wedge is going to be the opposite. Expectation would be to the downside. So if there's a divergence of price going to the upside, okay, and that pattern fails to conform, to perform in line with standard expectations of the market, then yes, we're going to target the apex of the rising wedge. Okay, so when we cover all this stuff, guys, it's big time stuff. Shout out to JMac. Boom. VIP caught a nice wedge tactic in the back yesterday, and bam. Nice trade, JMac. What's up? What's up? Nice trade tactic. And you see this, and this will be the deal. This will be the thing that'll get you in terms of the performance to the downside, this divergence away from the expectation of the pattern to price line, we want this as far away as we can possibly get this. Just FYI, we want this further from the apex. Is it uncomfortable? For many, yes. It's down to a value consideration. It's directly down to a value consideration. You guys know that. In terms of participation with an expectation of a return to the apex, that conclusion, literally the calculated apex is the conclusion of the demand function between buyers on support and sellers on resistance. It's literally a calculated level in the market. Okay, so as we were to look at the expectation of the DXY, we have equivalent buyers on support, sellers on resistance. We have a specific descending wedge. What was the specific expectation in the market? Well, this is supposed to be a bullish pattern. So we have a price line on the DXY, on the 8-hourly, to pattern divergence. We have a divergence wherein price line is failing to obey the norms in line with the expectations of the pattern. Capiche? Very nicely done. Okay, so what do? Well, we know that this specific apex is a calculated, literally a calculable point in the market. So we target that. We target the conclusion of the demand function on Bitcoin. Boom. And watch it get hit. Bam. Is it a lock guarantee? Nope. And it's kind of like the number one pattern in the market is what? Number one pattern in the market is like a 72. You get up to like 78% of the time. So what does that mean? 72% of the time you're going to make money. I always say, like at that blackjack table over there, 72% of the time you're going to win your hand. 72% of the time. Like, whoa, where's that table? Right? The casinos are good. Be careful. What's the idea there? 72% of the time you're going to win. You're like, well, I'm going to go take all my money over there. I'm going to go win. And what if you get 3 bad hands? Hold on. 3 bad hands on a table where I'm supposed to win 72% of the time? And the mind starts to calculate. Well, what would be the odds of me getting 3 bad hands in a row? I can understand 1 bad hand, right? 28% of the time, right? Do your math. In terms of that, just the math may be difficult to do when you're looking at the, it's like, hold on, the casino, the casino's going to find a way to make it difficult. So are the market makers. The market makers are going to find a way to make it difficult on you, without a doubt. Now, DXY rocking out of a very, very, let's solidify this targeting technique when we see the divergence of price line to the expectations of the pattern. This is our apex. Boom. It's a calculate. Literally calculate it. Guys, you can calculate it with a pen and paper. Literally from the trend line function, demand and the support, or the demand and the resistance rather. Bam. So as we target these, as we see their performance in the market from an empirical standpoint, meaning literal just data sets telling us that there is a likelihood, a strong likelihood to hit that pre-existing conclusion of the demand function, okay, from the support and the resistance. And that's how we do things around here. It's not a guess. It's not a maybe or, it's not a I think or a gut hunch. It is hundreds and then eventual thousands of patterns that we look at to confirm to us that this is worth looking at. And we operate in circles, literal, with tens and hundreds of thousands of patterns in play for us to decide how to approach the markets. That's just it. Literal tens and hundreds of thousands of patterns that are going to tell us and give us guidance, all right, in terms of how we were to deploy something like a capital control line, guys, in terms of capital in the markets. And the bottom line is, be prepared for that 28%. Be prepared for that 28% to, and we don't hear enough of this in the markets in terms of heavy cash reserves. You can blame us for having a kind of exotic or a unique targeting technique. You may say, well, that's something else. You're not going to blame us for telling everybody that would listen, heavy cash reserves, where? Bam. For 69,000, boom. Anyone who would listen, heavy cash reserves, boom. Because you're in such a volatile market, right? The lack of predictability is one of the finest features because you just may get your orders picked up below on Bitcoin. Bravo, bravo, bravo. You just may get those orders picked up if you're a patient soul, right? If you're attracted to volatility, man, it's a nice market. It's a real nice market. So yes, we target the specific apex of a failed, meaning to the downside, descending wedge. You're seeing that repeated on the DXY on the 8 hourly with the recovery to that level, reinforcement of VIP trade tactics. Oh, yeah. What's up, guys? Good job. Reinforcement. J-Mac in the house. J-Mac VIP all the way. What's up, J-Mac? Yo. Yo. What's up? Nice, nice trade tactic. We'll go into that. Let's go into the trade tactic and show what, not of the DXY particularly. We'll go into Tesla in a minute. Let's see what Tesla has in terms of targets to the upside or the downside, right? Because that's the greatest thing about the descending wedge or the ascending wedges. They're stacked everywhere. So you can find an apex to the downside of a failed rising wedge. You can find, right, a failed descending wedge either to the upside on the descending wedge or to the downside of an ascending wedge. The more you get involved in these, the easier your targeting is going to be in terms of direction. What we want is direction. And we didn't get satisfactory conclusion here to, let's say, Bitcoin on the macro. We didn't get the direction we wanted. Look at that from 65,000. We had a nice pattern. I mean, man, everybody was just stacked in, except the people with orders waiting below who wanted to get picked up and then boom to the upside. Yeah, that level of discipline and patience is rewarded in the markets. Big time. Big time. Do you have heavy cash reserves to participate at lower levels? Are you just showing up and well, is this month and maybe next month I'll find some additional cash to throw into the markets? Come on, guys. Come on. Not in VIP. In terms of the details. So that is essentially the targeting of the apex. It's incredible, but not surprising in the least to see this working out on the DXY, right? So DXY also in a pattern breaking, and you're going to have to look across time frame on this. This is a sticky issue, these time frames. Why can't we just get the same story? Dang it, right? That's part of the challenge. Finding that confirmation, multi-time frame. Let's look at the 8 hour. Let's go to the 4 hourly on the DXY. There you go. That 4 hourly is going to bring that line of resistance up. Boom. Okay. Nice. We could use a right shoulder here, no problem. We could use a right shoulder, or we could just look at this as an expansion to the downside. Nicely done. DXY coming out of our favorite pattern here on the hourly. What's our favorite pattern here with the highest degree of probability in the market? The highest degree of probability in the market, and nonetheless just as challenging, right? As we were to look at the specific pattern in play on the DXY on the hourly, what do we run into? We call these bell pattern formations. Now it's a broadening wedge and or can also be a bump and run reversal. Boom, boom. You see the expansion with the buyers on support, sellers on resistance. I need that to be expanding to become bullish. You need people to be attracted to the level of volatility. You need buyers to say, man, I like increasing volatility. I want to participate down here in stacking orders. It becomes very nice to trade. Now, that is the DXY rocking up and out of an increase, an expansion of volatility. It's a nice move by DXY right along that level of resistance. Is that on the 4 hourly? Check out that 4 hourly on your charts. Mark it, tag it, big deal. Big deal. You just saw the micro. Take a look at the micro on the hourly. On the DXY, what did you have? An expansion. Okay? Now compare that. Let's just do this. Let's compare that. I'll put this DXY on the hourly here. Let's put it on the downside screen as well, so you can see a nice comparative of what's being evaluated on the 4 hourly on the DXY versus the hourly. Now this is the 4 hourly. I'm going to pull up here. Let's go ahead and take care of this so that you can see on the 4 hourly. Where are we at on the 4 hourly versus the hourly on the DXY? You see on the top, you see the hourly. Yes, you see the hourly on the top chart. And good morning, ladies and gentlemen. Hope you're doing well. Man, we love the market, don't we? It's just one of those things. I don't hear anybody saying that. Do you guys hear anybody on Bloomberg or anybody else anywhere that you are plugged into saying, man, we love the market. We are so lucky to be trading. This is why we get up and do what we do. And this is what we do because we love this stuff. I got to tell you, I don't hear that from anybody. We say it all the time. And shout out to the VIP. It's what we love to do. We love the market. We grew up loving the markets. Hey, maybe you found it late in life, but I tell you, this whole take over Wall Street and forget the Fed and all this hostility, we love the markets. I'm not cozy with the Fed, guys. It's not I'm cozy with anything. I just really like the markets. We love the challenge. We love the whole notion of like placing capital in and the market producing for you on a high level of probability. What's not to like about that? Go to your broker, financial advisors not welcome. I literally know financial advisors who like literally are selling like, sneakers, Chinese sneakers on websites on the side. Like, to what, man? Like what? I'm a licensed broker. I'm a licensed financial advisor. And you're doing what? You're selling Chinese sneakers on websites on the side? Like, don't your clients know what you're doing? Truth, honest engine. Now, there are some incredible financial advisors. I chose not to be one with Morgan Stanley. That's okay. I love Morgan Stanley. Those guys rock the house. Old, Smith, Barney, legends. They're great. Love them to death. It just ain't me. I don't want to be selling Chinese sneakers on the side on a website. I'm not kidding, guys. There's not just one or two of them. I see this all over the place. Like, you're another financial advisor, and you have some weird, like, rave clothing store in downtown on the side. Like, okay, man. I don't know what it is. I don't know. It's like, don't your financial, clients, don't they want more of your time? Man, that standard of excellence is not easy to find. But when you find it, that's a good thing. And that's not a cross-the-board, cross-the-map kind of a complaint on financial advisors. There are some great ones out there. We are just determined to tell people that is not what we do. We just get to tell people. I don't know why. Anyway, looking at the level of resistance, level of support on the 4-hourly. 4-hourly. Now, near flat top resistance. Noted on this specific... Look at this on the specific DXY on the hourly. Level of resistance, level of support. I like this more descending. I like this descending framework on the hourly that we just popped up and out of. The odds of going back to the level of resistance is what? 62%. 62% based on what? Now, that's relevant because 62% is not quite 70%. And it's not quite 75%. And it certainly isn't 80 or 85%. Right on. So that's how 62% becomes relevant for me. It's relevant because, yes, it's the majority, but it's not 70%. You say 70% to me, I'm like, hold on. Let me get my bags packed. You 70%? Let me get my bags packed, huh? Yeah. You say like 75 to 80% for me? Man, I've almost got a secretary involved. If you say 75 to 80% with me, I've almost got a secretary involved making sure about all the trip details. Literally, I'm willing to get a secretary involved, a staff involved, everything else, like 70, 80%, 85%. Man, I've got the whole top floor involved, engaged, all of the details, trip agenda, everything that could get literally like... Guys, I start to motivate at a different level. You say 80% to me. 80% of the time? Yeah. I'm probably not the only one that thinks that way. What do you guys think? Like, man, the whole top floor of this place is dedicated to what? To like that 85% category. So it's just the mobilization of what the notion is, kind of a mobilization of like resource potential in terms of what's really attractive and worth focusing your and potentially other people's times on. Your resource allocation would be more heavily geared towards something that's going to perform in line with a 75 or an 80% or an 85%. Man, you're not going to be able to afford to miss anything. If something's in a category of 75, 80, 85%, you can't afford to miss that, guys. That's the level of priority that it should receive. Yeah, like something a 60, 62%. I'm kind of excited about it. I'm interested in it. But I'm not willing to really make sure it just doesn't have the same draw. So I bring that up in the context of a throwback to the specific volatility pattern, okay? Literally at this level here. As you would look at the percentage probability of a return to level of resistance, 62%. All right. 62%. I like operating along a level of support on these expansions. The bells. We rock the bells. Okay? We call them bell pattern formations, and they share the same componentry, the broadening wedge, with a bump and run reversal. Okay? Differentiation, bump and run reversal has a lead in. Okay? But as you look at the pattern in play here between the, let's look at this, in between, let's say between the broadening wedge and the bump and run reversal, you're going to see why we group them together. Look at the top line. Very important. Pay attention. If you want to get this and grasp this, pay attention. As you were to look at this zone in here, let's look at this zone right up in here. Okay? Big screen TV required here. VIP. Guys, VIP trader. That's who we are. Boom. Bitcoin spike. What is this little area up in here? This little area up in here that you would just pay attention to, say, well, this is a failed pattern. No, it's a lead-in dynamic to the first bump failure, no run. Yep. This is a lead-in for a bump without a run, and for a bump, now a second bump is trying to have a run. It's a reversal dynamic, and it happens to coincide perfectly within the context of what others will look at and say, no, that's a broadening wedge. That's a broadening wedge. If you don't understand the broadening wedge and the shared technical componentry with the bump and run, you're missing it. If you don't want to read 10 pages in a sophisticated guide that's like top shelf, if you don't want to do that, you're not going to get it. And if you don't want to get it, you're not going to beat the market. So you decide. You want to get it, you want to beat the market, or you want to just coast along and look for your we're past the point of everybody looking for their bull flags, or everybody just looking for their ascending triangles, which are failing all over the place. This is a challenging market. We like the challenge. You guys got that right, huh? We appreciate the dynamics at play to the extent that we're technically involved enough to understand how a bump and run is going to fold into a descending broadening wedge, and why we pay attention to the 70+% of the time that we're going to break this level of resistance. Boom. And what does it mean once you've broken the level of resistance? What are the other factors that come into play as to whether or not we're really going to skyrocket? Huh? Give me the 72% of the time. That's an alert function with me. 70 to 75 to 80 to 85, that's an alert function with me. If it's not to you, that means just a whatever. You're not in the markets. The triggers in the markets aren't triggering you correctly. I would argue that, guys, I think very successfully. Okay? If those types of probabilities mean something to you distinctly, then you're poised to be a nice heavy hitter in the markets, guys. You just are. If the probabilities, the specific probabilities from a 60%, if I offer you 60% in the market, if that's kind of interesting to you, but if I offer you 70% of the market, whoa. If I offer you 75%, whoa. If I offer you 80%, whoa, hold on. Yeah, guys, yeah, there's a big difference between 50%, 60%, 70, 75, and 80. Hold on, 85? It's a huge difference in the market. Huge. If those differences don't excite you at all in the market, they don't mean anything to you in the market, just pay a little more attention to those differences when they're engaging, when you're losing, and what's enabling you to make money in the market. And I'll just challenge you on that. Don't take it as advice. Just accept the challenge. Accept the challenge for right now. At least find the source for information as to what is 60, 65, 70, 75, 80, or 85 in the markets. Accept the challenge to find that out. Because the guy, I promise you this, the guy that's chilling out, that's making everything look easy in the market, he's chilling out. He wants to go for a long lunch. No problem. He wants to go for a long lunch at the five-star club, and it ain't no problem. He's in a trade. I tell you guys, listen up. I tell you guys, he makes it look easy. He makes it look easy at the table. You think he needs to tell everybody what his deal is? Does he need to tell everybody at the table what his deal is, what his secret formula is? He's got a formula for 72, 75, 80 to 85% success rate. Does he need to tell everybody what his No, he doesn't at all. No, he does not at all. So we're talking about success formulas at high levels of probabilities. But the guy at the five-star club, he's sit there, no problem, huh? Hey, but he makes it look easy. I'm telling you, it's 70 to 75% to 80 to 85% of probability. If you're there on your trades, you can make it look easy. You can make this stuff look easy if you want to. You don't have to tell anybody your secret. Do we have to sit here and tell it? We don't have to. This is our group. This is what we do. We want to be the best. I don't know, guys. We want to be the best. And I'm not sure that there's this huge agenda. As we look at the DXY on the hourly, on the 4 hourly, shared technical componentry. Now, I could probably hunt down a time frame to show me what I'd really like is a bit more of an angle on this top line, right? On that 4 hourly. I like a bit more of an angle. Things start to change for me when there's a flat top resistance, okay? Things start to change for me when there's a flat top resistance. Why? Because I want to be the guy at the club. I want to be the guy at the five-star club, chilling out, relaxing, and in my 72% to 75 to 80 to 85% on my trades. I want to be that guy. I want to make this look easy. All right. Now, when I provide that analogy, it is an analogy and an example for you to understand that as I start to get into this zone of the DXY of a flat top resistance, things change for me. I'm not going to be at the club, at the five-star resort, and relaxing and just being, I'm in a trade, no worries. Huh? Yeah, let me check in. Yeah, it's fine. Everything's fine. Yeah. That level of confidence is scaled back when I have a flat top resistance. On this pattern, the level of confidence is scaled back when I have a flat top resistance. I got to check in a little bit more. I got to go do a little bit more homework. I'm telling you guys, because the probabilities associated with a flat top resistance and a descending line of support, they're a little less favorable. They're a little less favorable than what I see like on the hourly. Okay? Little less favorable than what we see on the hourly. And that's the difference between the guy who's chilling out at the trader who's at the five-star resort for lunch again, playing racquetball at the club, lifting weights, powerhousing through and doing whatever he wants to, making it look easy. He's got an angled, on the hourly, he had an angled level of resistance. Angled down. Guy gets on into a flat top resistance or anything really resembling a flat top resistance, he's going to be looking like he's doing a little bit of work. Yeah, going to make him do a little bit of work. And the level of work is what? The level of work is probably from the 4 hourly down into the hourly. From that 4 hourly, near flat top resistance, he's going to have to hunt it on a time frame. He needs to get that instead of the flat top resistance on the 4 hourly, preferably hunting into descending line of resistance. Right on. Descending line of support. Right on. Those are the guys that are going to make it look easy. Now, this is going to be the deal. You're going to say, okay, great, this is going to look easy. This is what we're going to do. I'm going to put all my money into, excuse me? No. Those guys get thrown out of the club. Yep. Those guys don't last long at the five-star club making things look easy. They just don't. It's not an all-in game. You know this. And so just a little bit of a refresher on the patterns. We don't want, and after a refresher, if you didn't watch the beginning of the stream, take a look back at the over or under, the 20 moving average on your time frame of choice. take a look at it. New York is open. We had some strong jobs again on a Thursday. Strong labor market. Yes, 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 indeed. Okay. And nice to see Morgan Stanley up and around on the tail end of a Goldman Sachs Investor Day. Have an Investor Day. How great. Elon, they don't like the guy. That's all right. You go get him, Elon. Now, let's look at Bitcoin. You understand the preference for a descending line of resistance, descending line of support, and expansion. We want that divergence. Convergence means what? Convergence means things are coming together, converging. Like if we were in a descending, right, descending wedge, convergence would mean we have a constriction going on. Divergence means pulling apart, right? We have either a constriction or we have, let's just say, this expansion going on. We like those expansions, right? We just do. I want more price action. I want more price action. I want there to be a divergence between the level of support and level of resistance. That kind of volatility attracts traders. It attracts traders. Let's pay attention to Bitcoin on the hourly. On the hour, let's go to the 15-minute, right? 15-minute, what do we have? On the 15-minute, we have a flat top resistance, real close, slightly ascending, right? Now, the ascending triangles have been like a plague to Bitcoin. Typically, they are bullish patterns. Typically, they're bullish patterns, but they've been awful. Recently, they've just been awful. So within that context, we've had some incredible recoveries, and we've had some nice opportunities to trade. Now, I'm saying the word trade. What happened guys, what happened in the shutdown? What occurred? Everybody was giving cash. The whole world was giving cash. There you go. Take your money. Now, what happened? Let's look at the 15-minute. Look at your specific. It's a great moment here. As we look at the 15-minute Bollinger Band. What are we investigating on the Bollinger Band? We need to be up and over that 20-moving average. You can say it's completely irrelevant. I'm so sorry, sir. It's completely irrelevant. It's the key indicator on the 15-minute in the last 11-plus hours for Bitcoin. You can't get up and hold over the 20-moving average. We want to go up. Well, you're beating your head up against the 20-moving average on the 15-minute. It's just not happening. It is not happening. Great Wall of China, not happening. 15-minute, all right? In the context of the patterning on the hourly, dig into that hourly. You've got what pattern in play? Near flat top resistance. Go to the candle wicks. You do have a flat top on the candle wicks, to be precise with this lead-in function here, that hitch. We'll call it a hitch. All right? Bam, bam, okay? Now, looking at the candle wicks always as a quick and easy methodology to get through differentiations on your time frames. Okay, how does that work? Well, the candle wick itself is going to be the same on the 1 hourly as the 30-minute, as the 15-minute, as the 5-minute. Across time frames, your candle wick is not going to change. Shouldn't change if your price charts are accurate, okay? If you have accuracy, we use TradingView, of course, and we're happy to use them. Now, but you should have the same here. Let's circle this just to prove the point. I want you to understand, when price gets to a level, now the problem is price is going to blend into, and it's going to aggregate the candles in this zone. So let's say on the hourly, but I'll tell you on this specific pivot here, price on a candle gets up to a point, and then it will close at a point. The point it gets up to isn't going to change on the 30-minute versus the 15-minute. It's still going to get up to that point, but you'll have different bodies of candles within the 15-minute versus the 30-minute, okay? But the specific high on the hourly is still going to be the high on, let's say, the 45-minute. Is still going to be the high, let's say, on the 30-minute. Is still going to be the high, let's say, on the 15-minute. It still got to that point. Price still got to that point on the 5-minute, and price still got up to that point on the 3-minute. Okay? Now the lines can tell a different story. That's the 3 minute, that's the 5 minutes consistent. On the 15-minute, whoa, the whole equation fell apart. You see the 3, the 5 minute on the line. Differentiation. This represents the line, represents the candle close of price. All right? The actual maximum price is going to be represented by that candle wick. So, quick and easy cross time frame analysis, look at your candles. Okay? Just check your candles. It'll give you a kind of a normalized. It'll normalize price action across the time frames. It's a quick and easy approach. Seeing on DXY a return to prior resistance. Now, you may note as I talk about expansion plays, you may note what, guys? That I'll tell you 62% of the time, yes, it is a what, guys? It is a probability, tradable probability. 62% of the time, you're going back to the level of resistance. I will tell you that there is a tendency in the market, if you trade Bitcoin, you know this, and if you trade these patterns, you know this, or anything that's highly volatile. We may go through Tesla here in another minute. Nice move down to target on what? On the 8-hourly Bollinger Band, lower band. Boom was the open, right? On the lower band. Only 8 hourly. Look into it. You'll see that was the level that got hit. New York Institute of Finance, pro traders, not pro traders that work at a prop firm, guys. Necessarily pro traders like BlackRock, JP Morgan, Goldman Sachs, Morgan Stanley, right? The big traders on Wall Street that go New York Institute of Finance, right? That's where Wall Street goes to school. They can defend themselves in the market. So when I talk about the expansion here, we talk about bump and run, double bump with run potential. That's the pattern in play, along with an expanding, descending, broadening wedge. We group them together. We call them bells because it's a lot to process, right? It's a lot to process. A double bump and run reversal with the lead in the bump, the second bump, and we're trying to run. We're going to put it in a category of its own, guys, and include therewith the bump and run reversal with the broadening wedge. High on the agenda, very, very high on the agenda due to the probabilities involved. Yes, very, very high on the agenda, right? Very high on the agenda. I want to say good morning. Hope you guys are doing well. Why do we do this stuff? We happen to be the group that just loves the market. We literally breakfast, lunch, and dinner. And I'm going to breakfast, lunch, and dinner, snacks, everything. I want the market. We want to beat the market. That's just it. We have this drive to want to beat the market. Near superhuman forces are deployed into the overall effort. At least the following. And shout out and good morning to all the VIP. I'm not going to mention a name. It has some cross-trader relevance. The superhero in the market is what? Is you. Yes, the superhero in the market is who? It's you. It's you. When you can wake up and book 4 positive trades, you better believe it. And how do you get there? How do you become the superhero in the market? Oh, yeah. You engage in hundreds of trades. Hundreds of trades. You get on that same boat that the Goldman Sachs guys and the JP Morgan guys and the BlackRock guys and the Renaissance Technology guys and the Citadel guys that they're on. They're trading with sophisticated understanding, with an appropriate understanding of the technicals. As we look at the return to the prior resistance on the DXY, yes, we have a 62% chance of getting here. It's relevant 62% because it's not 70, 75, or 80 or 85. I mean, at 85%, man, this sucker's gonna go. 62, a little bit of breathing room needed. Nice short nonetheless. But the lack of really demonstrable, really just satisfying that high probability need to operate in the market, that 70, 75, 80, 85%, man, There's a big difference between 62% and 70% or 75%. There's a big difference, guys. And when you're operating in line with the 75%, you know it. When you're operating at the 80 or 85%, you know it. It's that guy who makes everything look easy. It's a big deal. It's a real big deal. You want to walk around making it look easy, huh? Hey, that's what we're talking about. Now, DXY on the bottom here. Let's take a look. What did we trade yesterday? First of all, where was that? Nice. What was that on the 30-minute? I believe so. Shout out to J-Mac. What's up, J-Mac? Nice call on the upside target on the pour down yesterday. Beautifully well done. When you see trade tactics work out, it's like, man, depending upon the pattern, we haven't done a lot of this, but depending upon what pattern you're in, I will tell you, you will see more of these trade tactics hit than you would care to not have focused on. Man, you don't want to miss these. Pour down out of what on the 30 minutes? On the 30-minute, we had a descending wedge. What's the expectation? The expectation generally conforms to price up and out of this to the upside, so we had a divergence. You won't hear about these types of divergences. It's a divergence of price line to pattern expectation or pattern performance. Price line to the downside, diverging from that which is expected, which would have been a move to the upside. When we see that divergence, a failure of price to conform to the pattern expectations, the demand function of buyers on support, sellers on resistance, this is right here. That is a calculated level, okay? That's a calculated level. Literally, it's the conclusion of the demand function between buyers on support, sellers on resistance. It's an actual price, a discernible actual price in the markets. You guys know this. So that is what we look at in terms of targeting to the upside. And shout out to the VIP. Good morning. Hope you're all doing well. We are in California. You got it right, La Jolla. La Jolla, beautiful La Jolla, crown jewel of Southern California. And we're excited to be here. And shout out to all the California crew. What's going on, guys? Or the New York crew, or the Australia crew, or the Texas crew, or the, you guys name it. From Missouri to St. Louis to wherever, guys, to Tokyo, Hong Kong, good morning. Hope you're doing well. Philly, yeah. Philly, yeah, we got the Philly. Support resistance. So this specific target on Bitcoin, look at that. Targeting due to the divergence of the price line and diverging from the expectation of the market that we would see positive breakout. We're going to target failed descending wedges. We're going to target failed ascending wedges, right? On the ascending front, we have an ascending wedge here on the 30-minute that performed exactly the way it needed to. We didn't have to target this one. It performed exactly the way it wanted to. There was no divergence in price. Boom, to the downside. That's what an ascending wedge is supposed to do. But a descending wedge is not supposed to. The general expectations is not a break down. So when we see that divergence, and it's divergence of price to pattern expectation, then we're going to target that. Nice move. Very nice move. Now, we're still battling that 30-minute. We just rocked into another candle. Let's see where we're at. Another candle right at the threshold. Let's see where we're at. How would you trade this? Let's look into the 5-minute. What do we say, guys? Looking at the pattern framework, she's going to do this to us. She knows. She dangles that carrot, that 72% probability. Now, what was the nice thing? This was a pattern pickup yesterday. I know VIP made money. You better believe it. It's like, oh, we had an expression of the downside. To where? To support. Through support, even better. Even better. Break this down through support. Break it. Hammer in. Boom, boom, boom. Nice trajectory back up to resistance. Waiting to launch, huh? Waiting to launch. Those launch codes. You need those launch codes, right? So we are in the overall bullish expression. On the 5-minute, counterbalanced 1 hour DXY, mixed correlations. It's the weekend trading. The weekend trading with Bitcoin can send her in any direction she wants to go. Huh? So as we look at the micro, as I am focused on the specifics in terms of the pattern formation, you take the 28% and you frame it. 72% of the time is a high probability. And what is it requiring? I don't believe, as I talk about what happened in the pandemic, et cetera, post-pandemic with the assistance functions that were handed out, et cetera, what happened? Everybody put their money into the market. And what happened to the majority? Let's talk about opportunity to just make vast amounts of capital, especially if you knew what you were doing. People made very, very good money, right? And so the bear market is now turned into an equation of as we are sitting here daily and talking about, what are we talking about? Something very relevant. And it's relevant on the 5-minute and it's relevant on the hourly and the 4-hourly and the daily and the weekly. We've been pushed into a different segue in terms of the market, wherein now we're talking about capital allocation. Now we're talking about the fact the market will let you make money, but the question is how much, and don't get too aggressive on the how much. You understand that? You have to understand that tens of millions and hundreds of millions of traders across the world were thrown into the markets. Yes, with cash to deploy. And it has gone from this near free-for-all in terms of everyone with expectations to make all of this cash. The whole world's going to make all this cash. No, it's gone into discussions, appropriate discussions, in terms of, and there's been kind of a recentering. And do mind on the 15-minute that we have a flat top resistance, okay? We have an ascending line of support, okay, as you look into your participation in this pattern, which reinforces something that we pay a lot of attention to, which is the notion that, yes, directional probabilities are important without a doubt, and they are included with the notion that participation at lower levels, okay, is essentially going to be required, or at least the contingent for participation at lower levels is required. The hatch closed, right? In terms of, or the endless, boundless, and on every major index, the free for all, absolute sky is the limit. Let's all go make tons of returns. The hatch closed, right? And we begin a different involvement with the market with the understanding that you can make money, but you're going to have to accumulate at lower levels. It's going to reward people who have been around maybe for a while or are going to be around for an additional period of time. And within the construct that we're looking at, I love, and I get to go to, let's say, for instance, the NASDAQ, just to prove this point. As we look at the NASDAQ, the reward dynamic has shifted in the markets away from a free-for-all. I mean, it's never really going down. Do you think, well, one day it's going to go down? We all said, right? One day it needs to go down. It needs a healthy correction. But as you look at this equation, this is an equation that is rewarding. It's requiring at least the contingent for lower prices, right? You can do this on the NASDAQ, on the S&P, on anything. As you look at you're going to look at a myriad of patterns right now. You just are. You're going to look at a myriad of patterns that are coming to play. But it's requiring people to trade. It's requiring, if you're let's say a diligently structured, consistent futures trader, you have a different existence now due to the trend dynamic in play and kind of the pattern that is unveiling itself. If you're a 401k, I would just imagine, you guys tell me what your thoughts are. But if you're a 401k, or I've got all my money in Tesla, or I've got all my money into IBM or Coca-Cola or Bitcoin or whatever it may be, The market has closed the hatch from here we go. It's all to the moon. Everybody's going to get completely wealthy in the world. Everyone's going to get just hold on. Wealth is the only thing that we can foresee in the near future. We've shifted away from that, and it's very relevant because what you've shifted into is this last, let's say, how many days have we been at this? This is highly relevant. Last 445 days, you've shifted into a need to calculatively involve your money now in the markets. It wasn't all in. It wasn't everybody. Everyone from India to Hong Kong to New York to Missouri, right? To Argentina. We talked with them all. We talked with all of them, guys. Not all, each and every one, but from all of those places. And you were literally trajecting towards higher levels of wealth, no problem. To now, it's like, whoa. Someone closed the hatch and said, yes, you can, but now we're going to require all of you, the bulk of you, instead of just trajecting into states of infinite wealth, right? Literally, it was just everyone, you guys know, the trend was solid, wasn't it? But as we looked at this, at your involvement now, your opportunity to make money is still there, but your calculations differently. You're purposing yourself into an allocation methodology, which doesn't just point all roads lead to Rome, and Rome being massive increase in wealth. No, now it's a little bit more calculating. Now, traders, it's a little bit more potentially. There is no underlying assumption of wealth. Now it's more of a game of exposure, right? It's a game of you calculating your entries. This is on the NASDAQ, and that's what this says to me. You have levels and pickups where capital deployment is rewarded. Bit variability here, right? You can justify whatever you'd like to, but as we get into this zone, I don't expect the overall equation to change. It's rewarding those who are willing and able to participate at lower levels. That has been the equation thus far. If you can't participate at a lower level from here, let's say, then are you trading? No, you're holding. The traders who can participate at lower levels from any specific point here are the ones that are being rewarded. And I just like the shift. It's an important shift for traders to recognize that you're in right now. Not the accumulated. This is the NASDAQ. Just looking at it. It's not the all roads lead to Rome, and Rome is just, it's bliss. It's all wealth. Well, all we're doing is creating wealth. No, now it's like the dynamic, the paradigm has shifted to where all of the hundreds of millions of traders and investors, hundreds of millions of traders and investors, right? No, it's not all into a solid equation for just wealth creation. Now it's shifted away from that expectation to, and everybody was trading, guys. You had petroleum engineers going to cigar bars, literally day trading like they were professionals. Everybody across a petroleum engineer. No problem with that, but his petroleum engineering is his specialty. But he was focused on creation of wealth. Guys, hundreds of millions of people fell into that category with check in hand. Boom, we're going to the trajectory of wealth. Now it is more in line with a structured approach of heavier cash reserves being deployed at levels to cover upside exposure, calculative involvement with the markets, right? So just notice that shift in the market, and notice that you're involved in the markets right now where the expectation of wealth, I mean, if someone's selling that to you right now, whatever you're being fed, however you're involved in it, it's just looking at the last 400 days, it hasn't been rewarding to people who are just unilaterally focused at the moon, right? So you can focus on that if you want to, but we're focused down here. As we look at this as a matter of principle here, if you were to look at a Fibonacci wedge, we're focused on levels. If I were to lay this out right about like this, I can tighten this up and make it more aggressive. Okay, I can tighten this up, make it more aggressive, and just say that this is our level of capital exposure. We have two more rungs here. Okay? We have two more rungs here in terms of deep level capital involvement. Or I could make this a lot more conservative. And I could say we have, as you were to look at this, we have several rungs of additional capital exposure that we would enjoy placing into the markets. You do this on anything. This is just on the NASDAQ. You can make it even more conservative. Say we're in it for the long term. We appreciate the levels of volatility the market is offering, and we have 1, 2, 3, 4 additional levels, right? Back through and including to the, was it March 2020 COVID low. And we're prepared to operate and distribute our funds, guys. I know that would feel a little rough. I'm going to tell you that. I have to laugh at that because we're back to the critical shutdown element of the markets. You guys remember the plugs were pulled right on the markets. Remember? When's the last time you got the plug pulled on a market? NASDAQ, New York Stock Exchange. When's the last time they shut down trading? When has that happened? In the last 400? No, this has been a slow, deliberate, methodical breach to the downside. You mean all those hundreds of millions of people aren't just going to get rich and become wealthy? Generational wealth for the hundreds and hundreds of millions of people investing in the markets? No. This has been a slow, deliberate, and I say slow and deliberate because there's been that shift in that dynamic. You can make this as aggressive as you want, and you'll hear every different type of commentary on your Bloomberg, guys, or CNN or Fox Business or anything. There are people who say, no, we are here. We are right here in the market. We have allocated aggressively for our clients because some of those clients want that. You know that. Some of those clients, they want to be aggressively involved right now, right? We have aggressively involved ourselves. We believe this is, the Fed pivot. Ad nauseum if needed. You'll have other people that say, no, we are actually well structured in terms of ability to participate at lower levels, and we believe, Morgan Stanley, potential drop in S&P of an additional 20%. Okay, and I have this expansion here because it is the pattern in play. It's the pattern in play. Just understand that we haven't had the markets shut down. Have we had trading suspended? I don't think so. I know we did here, right, with 2020 with COVID shut down, right? The market, the stops in the market literally engaged. Yes, this has been a slow, deliberate unwinding. Hello, a slow, deliberate unwinding, which is offering lower prices. And at the same time, it is disinteresting so many people from the process of trading. I'm glad that you are still engaged in the process. So it makes us who we are, guys. It just does. And so looking at this, let's just measure out that 20% additional drop that we could have. Really? Morgan Stanley. Morgan Stanley doing what? Calling out some gangbuster move, huh? That'd be a gangbuster move back down to a prior significant level of support. An additional 20% loss on the S&P? Significant enough. We're going to pay attention. They're kind of the top dogs in town. Up to a 20% move. All right. So he's hitching back to this primary level of support. We've already hit what on the S&P? This primary level of support. So it would be back into and through this level of support. Okay. The next major support level is what the top dogs in town are saying, guys. It's nice to know that you can make this as aggressive of a process. It'll be more uncomfortable if you're wrong. To more conservative of a process. It'll be a lot more comfortable to the extent that you were wrong. And I talk about taking people behind enemy lines, right? What does that mean? If you want to go too aggressively into the market, try just throwing like a tenth of what you wanted to throw in there. I tell everybody that. You would be amazed at how many times they say, London, that was awesome. But when you're throwing a tenth into the market, just throw 1/10 of what you wanted to throw into it. See if you were right. See if you were the genius you thought you were. It seems like 9 times out of 10, you're going to be given another opportunity to buy in lower. Uh-huh. And so when I say I take it behind enemy lines, it's like I threw a tenth into the market and like, whoa, it operated against me and I'm still here. Now what? It's like you're still alive, you're still breathing. I mean, I know you wanted to throw in. People get involved in the markets. They want to, you guys know this? They literally want to borrow money. Guys, they want to borrow money. You know, this is the best idea. They're convinced. They just watch this amazing video and whatever it would be on YouTube or Twitch or who knows. And they literally want to go out and borrow money. It's like, this is such a great investment. I got to borrow money. I got to put more money into it. Like, hold on, man. Try putting 1/10 of what you wanted to put into the market. You don't hear anybody telling you this. It's just me. It's not financial advice on Tesla or anything else. It just happens to be what has been extraordinarily successful as we have capitulated through the entirety of this. I'm a strange cat, guys. I'm a strange cat. Not necessarily, okay? But I've been telling people this for a long time. Everyone knows I'm the cat right here, just so that you know in terms of this. And I kind of backed up at this point, but it was 48 hours. You guys know, when was this? Just look at the 2008 crash. I'm one of these cats, guys. It was literally like 48 hours before the biggest bam to the downside for the 2008 crash. 48 hours beforehand, I went to all cash and literally had additional documents and everything else around me in any world that could possibly be affected by the markets. Everything went to cash. 48 hours before the biggest plunge in the dang market since like the 20s or what. It was bad. So that's just me. That's just me. Like this up here, I just tell you, yes, I've been telling everyone, heavy cash reserves. It's just kind of, I tell you, it's lonely. It's lonely at the top, right? It is lonely at the top, literally. You got to be that way because honestly, guys, you got to be. The whole world's looking up. The whole world's looking at this wealth creation. So when I say it's been a slow, deliberate decline, it just has been. And appreciate that fact, that dynamic in the markets, okay? Appreciate that fact in the markets. This on the weekly on the S&P is not unlike what we just saw. Make the analogy on and we're just going through patterns right now, guys. Very important. Looking at that ascending triangulation, we just had this on Bitcoin. We just had this. Man, come on, S&P on the weekly, come on. You had a perfectly flat top resistance. Perfectly flat top resistance. I know the 200's in play. I know that guy's on 200 daily. But look at this perfect flat top resistance. What is important right now is we don't like these to underperform right here. Grr. We just don't. If you're a bull, you don't like that. You just saw that you just saw this on Bitcoin. The fallout can feel disastrous. Underperforming ascending triangle, flat top resistance, ascending line of support. These can just, as a matter of fact, go listen to Morgan Stanley or go turn on your Bloomberg if you want to invest on it, guys. But looking at this is not as it's a little bit painful, isn't it? Generally we don't like ascending triangles. Two, we don't appreciate ascending triangles when they underperform and turn into a rising wedge, right? Now, what's relevant on the weekly for the S&P, just in line with everything we've talked about, would be this specific weekly, right? You've touched down below. We're going to be watching the weekly to see if we get a close underneath that specific 20 moving average. So, back into the detail on Bitcoin. Back into the detail on standard deviations. If something's challenging to you, get it, guys. Pay attention to it. Go after it. I want you guys to understand every dynamic of the market better than you thought you couldn't when it first confused you or first challenged you. I want you to not have a single thing in your way in terms of just dominating the markets. Isn't that cool? And the bottom line is that normally the only thing in the way is going to be you. Certainly don't want it to ever be me. If you figure out something you disagree with it, go reinforce it. Bring it up to my attention and say, hey, London, look at what I found here or found there. Let's do it. Let's do it. I love that kind of a mindset that wants to reinforce or validate or verify or cross-check or assess something. Always make that assessment. Look at your performance. Make that assessment. Look at how efficiently you're spending your time in the market. Make that assessment. Right? Look at your patterns. Are you overly aggressive, like we just talked about in the S&P? Are you overly aggressive anytime you find one of these? I need to expand my level of thinking, my ability to participate on these. Once I've identified a pattern, I need to lighten up, guys. Lighten up on yourselves. You know, this is a 5-minute decision, split-minute decision. I have to be right here. Lighten up on yourself. Give yourself some additional trades, next 100, next 200, next 300 trades. Give yourself 500 additional trades. Give it to yourself. You say, I want to project a goal. I want to be trading, I want to be trading at 100x with $20,000 positions. I want to trade 100x with like $40,000 positions. That's just what I want. I want to trade 100x at $40,000 positions. Man, you serious? So just so I understand what you want, your goal, hypothetical trader, you want to trade $40,000 on a 100x position. So just so I get this right, if Bitcoin moves 1% in your direction, you want to make $40,000. That's what you want to do. On a day in and day out in the morning, you want to know the markets well enough. You want to have kind of earned the privilege to literally operate with $40,000 on 100x, to where when a move on a single any given morning goes in your favor 1%, you can lock in $40,000 of profits just like that. 40 grand. Okay. What do we need to do to get there? What do we need to do to get there? Don't go to the equation right now that you need more capital. Typically, you need less capital involved in your trades. You need to get through more trades. Okay? Yes. I want to hear about the traders who want to involve. Hold on. And the next question, can I involve $100,000? How can I do $100,000 at 100x? Because I want to get this down. I want to know this. And if I can get a 1% move, ideally, I know it's a lot, but in the morning, I'd like to rake in $100,000. Good. How about $1 million? Better. Right? Bravo. It's going to be a different experience for each and every one of you, which is the good part of this. You may say, man, I just want to involve. I want to be consistently involved at a 10% leverage or 10x leverage, or I just want to be a good spot trader, man. I want to be the best spot trader in town. Hey, you want to be the best spot trader in town? Yeah. You want like a 98% win rate? Yeah. Let's go get it. What do you need to do? Let's go get it. Right? Focus on your probabilities. Remember the profile we talked about. Focus on your probabilities. Focus on your levels of consistent involvement. I love hearing from you all, particularly when you're talking about being involved on a level of support or on a breach of a level of support. You're getting it. And the higher probability trades mean what? Just so that we cover this, they mean what? And there's a great example right here. Because look, okay, we have a micro feature. Let's clean this up just a touch. Shout out and good morning to our VIP. Hope you guys are doing well. I know that you are. We talk. We get to talk about success. We love success in the markets. That's why we do this. We love the markets. Let's get into this. Because you have the macro, and then you have the micro participating in. And it's great when it doesn't feel like this. I would say it is wonderful. Huh? So I get to watch 2 sunrises, man. It's so awesome. I love sunrise, the best time of day. It's like I get to watch 2 sunrises, something phenomenal. If participating in the highest probability trades doesn't mean you have to wait longer, right? Because that's the problem. Now, on your lower time frames, on your 5-second, 15-second, 30-second, you're going to get into more trades. Yes. But the notion that if you hunt these things down, if you hunt down higher probability trades, go cross time frame. Because that's the one thing as you look at your level of success and your development, in terms of ability to produce consistently good returns, guys, consistently positive trades. When you look at booking positive trades, the one fallback in terms of your ability to progress is going to be, well, if I'm only involving myself in the highest probability of trades, I may be actually trading less. Yeah? Hunt them down. Find them. Right? Dig in. Get on your 30 second. Get on your 15 second. Work your Bollinger Bands. Right? Work your standard deviations with the understanding of to the upside. I'm going to tell you your standard deviations and your Bollinger Band tactics are not going to be what you're looking at on the screen right now in terms of percentages. They're just not. But you might find a time frame where traders are trading that Bollinger Band. It's like, whoa, eureka, found it. So that's going to be something that we're going to focus on as we just roll this all into, well, pie is the sky. It must be great, huh? Promise the world, huh? No, I ain't promising the world, huh? Not happening. You think it's easy? It's not easy. We'll go through a whole big round of how easy it is not. We will do that if required, and it should be all over the map that it's not easy to perform at extremely high levels. The levels I've been discussing are extraordinarily high levels. I have seen extraordinary traders fail to perform, drastically fail those standards that I just talked about. Drastically fail. Extraordinary traders from institutional high perch King Kong desks at those offices. I have seen them in an individual context fail the norms and standards that I'm talking about. Hello? Like the number ones, I've seen them fail. Hello, guys. No easy street. No shortcut to success. Anything that's worthwhile typically takes time. Notch your profile in with the market, your degree of experience. Build your profile in terms of consistent. What we got here? 4 hourly Bollinger Band BTC. I saw that. Indeed. Let me put this for Venus. What's Venus doing? She's looking at the 4 hourly Bollinger Bands. Let's see what she's got. We love it. What do we got? Bum, 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 bum. And the copy back onto the 4 hour Bollinger Bands. We talked about this yesterday in terms of the potential for the moving average to act as resistance prior to or after a hit to target or after a cross. Kind of some advanced approach there to the classic trading tactic. And I just bring up the level of success that you want to have, and I want you to appreciate the challenges that are in front of you and just that they're not unique to you. And the guys that make it look easy, I want you guys need to be the guys and girls that make it look easy. It's like, at the end of the day, it's like, it's still a lot of work. We know this, right? We know this. So we're in a bullish pattern here. What would we ideally like on this? The last thing in the world anyone who shows up and wants to make money wants to hear. We want the action now. We want to move to the upside now. The level of support drop is the ideal. Here, the larger the volatility between the buyers on support, sellers on resistance. Yesterday was a great example of that. The trader that doesn't want the drop, pay attention. The trader that doesn't want the drop doesn't appreciate the volatility. Okay? You don't appreciate the drop. What are you not appreciating? The literal measurements on the map and the advantage of dropping in a bullish pattern. With the drop, you get a larger range. Indeed. For most traders, the amount of involvement becomes the sticking point. Well, how much, if I have to carry from here to here, 2%, do I need to invest from here to here? 2% to 1.6%. If I'm going from, we'll get into this, there's some different calculations involved. If we get from 1.6% down to 2.9%, And if we go from 2.9% back up to 2%, how is that not a losing equation? Because I'm losing 2.9%, I'm only making 2.19%. We want to throw this into an Excel spreadsheet or some sort of a return calculative quickly. You want to return this into a lighter load, a heavier load. And then you want to measure with your probabilities, turning the let's say the 3% into, well, let's just say we get back to the pattern top, 4%. Okay? And then you want to turn into well, let's say that we have 1 in 4 of these that decide to go, let's say that decide to go, let's see here, up to 8%. Okay, so I've got a equation that changes. From the quick and easy, everybody's going to realize the challenge of the 3% drop recoverable to a line of resistance. Yes, it's challenging unless you account for the actual amount, heavier and lighter. At least back to pattern top, 4%. Okay, that's a nice equation. That 1 in 4 becomes very interesting, doesn't it? That's why we trade these. That 1 in 4, let's say the 1 in 4. That's going to blast and looks like at least a double of your loss potential. Now, I don't want to get into risk-reward ratios right now. I also don't want to get you off of the challenge here of trading in line with a max amount of leverage if you can handle it. If you can't handle it, go lighter on your leverage. If you can't handle it. If you didn't do 100 rounds, you don't know. If you're not in a position to book positive trades, just here, all through here, right? If you're not in a position where you're booking positive trades, like 4 or 5 positive trades all the time, I tell you, you're not trading a lot. If you're trading a lot and you've traded a lot, you're booking positive trades, right? That's just generally that's what I see from traders, bottom line. Something's rolling over in terms of its technical, some level of resistance that's been respected is getting hit again. Same scenario as we would dig back into the Bollingers. Something's failing. Bulls are failing somewhere. It doesn't seem like a great discussion because it's somewhat challenging. But somewhere, somehow, there's a failure to what was it, the 30 minutes? As we were to look back at, let's just say the last several hours here, we had a hit up and over nearly to target, right? And over the last 14 hours, we've had an inability, let's say, on that friend or foe 30-minute time frame, inability over the last 15 hours to get up and over the 20 moving average. It's just been the brick wall. It just has been. What happened here? Brick wall. Did you set a candle up and over? No. Is it just intuitive to wait? No, it's not. To wait till the session closes, to wait the 30 minutes to see if we have the close. You have to love this stuff to get into it, to give it enough time to become good at it. The ones who put enough time into it to become good at it, bravo. I get to deal with you guys, and you're awesome. That's what we do. So let's do this. Let's call it a morning. Let's talk about equities real quickly. We went through DXY, a lot of positivity in terms of just understanding differential standard deviations. It's good stuff. A little bit red on equities. Was it the jobs report? DXY doing well. And crypto's in the red. Opportunity Central, guys. Opportunity Central. Find your golden key, right? Your golden key is going to open whatever door you want to in the market. Stick with it. Stick with your with your cross time frame. Very important as you look at your 8-hourly. That 8-hourly is tough right now. You guys see the 8-hourly on Bitcoin? It's tough. Let's see what she's got. That's a rough set. indecision. We're at a point of indecision. Know when sometimes it's better just to say, I'm out for a minute. I'm going to relax. I want my higher probability. It's not like going to the orchard and the whole orchard is yours. You just go pick as much fruit as you want to off all the trees forever, and they're all. It's not like that. You need to be discerning. You need to look at, and don't be too hesitant. But as you look at the 8 hourly, like that's an 8 hourly really picky, huh? She's fussy on the 8 hourly. That's a tough little candle there, right underneath that 20 doji, Highland doji, right? Potential reversal, potential indecision while we're straddling on the daily. Man. Let's dig into lower time frames. We had a great day yesterday trading. It was awesome, huh? And she does this. The market does this. It's like pushes you into this state of kind of like, okay, we're kind of waiting for a nice hit along a high probability trade. Yeah, let's go get another one. We got one yesterday. This is London with Bitcoin Spike and VIP Trader. Good morning to all of you. Hope you're doing well. Hope you have a great day. We're going to have a great weekend, another VIP weekend. Get excited. I wanted to talk to you today, and I thought, what can I talk to the VIP about? And what I wanted to talk to you just about overall is the fact that we love the markets. Yes, we love the markets. We are in a bear market. And whether or not it's a bull market or a bear market, we want it to be your market. And I want you excited about the markets. This is what we love. This is what we do, right? So I thought, what would the VIP want to wake up and hear this morning? Man, do we love this market. It's the truth, right? It's why you're involved in the market. It's why we're involved in the market. We want to beat the market. We enjoy beating the market. There's a few greater things in life, of course, but we love beating the market. And I love beating the markets with you guys. Excited that you're here. And I wanted to inspire you to that extent. That's what you're going to get here. That's what you're going to get with me. Man, there's this guy that won't shut up about beating the market. It's like he loves to do that. I don't know why. Hey, that would be us. Guys, let's go get it. This is London. Hope you have a great day. We'll talk to you soon. Thanks for spending the market open with me. We'll talk to you soon, guys. Take care. Bye-bye.